I'm just suggesting to you that the measures that are being imposed on the Russians are unlikely to have much of an impact on Russia.
Hey, welcome back to The Dive. Our guest today will share his thoughts on the G7 ban on imports of gold, Russia's default on foreign debt, the reliance on Russian uranium, the yield curve, oil, possible global food shortages, and battle bank. He's a veteran investor, speculator, and one of our regulars here at The Dive. Rick Rule is joining us today. Hey, Rick, welcome back to The Dive.
Cassandra, always a pleasure to be with you. Thank you for having me back.
Yes, it's always great to have you on. Thank you so much for joining us today. Okay, so let's dive right into it. President Joe Biden and other G7 leaders are set to announce a ban on the import of gold from Russia. How do you think that gold reacts to a ban on Russian gold imports?
I think the fact that 7 political leaders who have a long track record of ineffectiveness and lying, let's just say that I assign the importance to it which it deserves, which is to say none whatsoever. Gold is very fungible, and the fact that the G7 won't import Russian gold doesn't mean that that gold won't be sold. Once that gold has been sold, it will become Indian gold or Dubai gold or Vietnam gold, and will find its way into the market. This is political theater at its finest. I'm not suggesting that the Russians don't perhaps need to be punished, but what I am trying to say is that this is a political act. You'll notice that the sanctions on Russia don't apply to commodities where voters' interests might be harmed. So I would regard the statement by the G7 leaders with regards to Russian gold, knowing that gold is fungible, as political theater at either its finest or its worst, which is in fact the same statement. I think it'll have no impact whatsoever. It might have a psychological impact on people who actually believe that Mr. Biden serves some useful purpose. I don't happen to be among those people.
Okay, now Russia has defaulted on its foreign currency debt for the first time in more than a century. Will Russia's debt default have an impact on global markets? And what do you think that Russia's debt default means for its war on Ukraine?
In the near term, the default doesn't matter. What it does is give the Russians an excuse not to make payments. In other words, Russia is in the near term a beneficiary of this. Note that the default is artificial. What the West did is we made it impossible. All of the Russians have the money for the Russians to pay their creditors, who just happen to be Western. Once again, I'm not suggesting that there shouldn't be some fairly strong political measures against Russia. I'm just suggesting to you that the measures that are being imposed on the Russians are unlikely to have much of an impact on Russia. While this may have some psychological impact on the market, I think that the impact will be fairly short term, because I think the ultimate economic impact of the Russian default will be minuscule. I think that the gold market always does well during periods of instability. But I think that the instability that will be the best for gold has to do with the instability around central banking in Western countries, which is to say the debt default that will matter the most to the gold price will be defaults that take place from private sources as the interest rate rises, things like home mortgage foreclosures. So while I think that debt default will have an impact on the gold price, I think the Russian debt default is more of a headline than a fundamental fact.
Okay, so I have one more question for you about Russia here. The US government is pushing legislators to support a $4.3 billion plan to reduce the nation's reliance on enriched uranium imports from Russia. Do you think that the US can wean itself off Russian uranium imports?
I do believe that the US can wean itself off Russian uranium imports fairly easily. Russia contributes about 8% to world export volumes of primary uranium, but their share of the enriched uranium market is about 40%. What happens if there's a shortage of enriched capacity is that reactors use more unbeneficiated or unenriched capacity. So what will happen as a consequence of the Russians at least being temporarily frozen out of the enriched market is simply that fabricators will use more unenriched fuel. And I think that the world will have a reasonably easy time dealing with the lack of Russian enrichment capacity in the near term. I think that the absence of Russian enrichment capacity will begin to be felt in the 18 to 24 month time frame. And what will be useful from the point of view of uranium prices will be the realization by utilities that in the 18 to 24 month time frame, that supplies will be tighter than they otherwise would. That in turn will cause utilities to rely more on the term market and less on the spot market, which will strengthen the overall market and give producers a much better sense of what type of cash flow they might expect. So I do believe that to the extent that sanctions against Russian enriched uranium continue, including informal sanctions, because there's a lot of utilities that aren't buying Russian fuel now for perceived political reasons, self-enforced sanctions. I do believe that they have the impact of causing utilities to be concerned about their supply chain and focused on the ability to maintain supplies to reactors. So I would regard this as at least a small positive.
So, how are you reading the yield curve in relation to the current inflationary environment, Rick?
Well, I think the yield curve represents a fight between the market and the Fed, which is to say the Fed is in effect pretending to tighten, which is what you're seeing in the forward yields, while still trying to keep current interest rates very, very, very low. From a banker's perspective, the current yield curve is the greatest thing since sliced bread. You can borrow from depositors at 50 basis points, and you can buy 2-year US Treasuries at 220 basis points. That's the simplest trade in the world. 160 basis point spread on a 10% equity slice means that the Fed is basically guaranteeing you an 18 to 20% return on equity. I mean, a truly crazy circumstance. The Fed is in a very, very, very difficult position. They have to let interest rates rise, if for no other reason than to be able to cut them. If we run into difficulty again, it's very difficult to cut from zero. And the impact of that is problematic. But if you were to allow interest rates to rise to sort of 4-decade means relative to the underlying rate of inflation, I think you'd run some risk of bringing the economy to a halt. Just for fun, Cassandra, let's do a little bit of arithmetic. I promise this will relate to the yield curve eventually. The US 10-year rate, the 10-year US 10-year Treasury being the most important debt instrument on the planet, that currently yields what, 3.4, something like that, in a currency that the US government itself, not some cranky old libertarian, Rick Rule, suggests is depreciating at between 8.6 and 8.8% a year, which is to say you get paid 3.3 or 3.4% a year for 10 years in a currency where your purchasing power is deteriorating by 8.5%. In other words, the Fed is basically guaranteeing you a 5% loss a year for 10 years. Hell of a deal. If you look back over 40 years, Cassandra, the US 10-year Treasury has had a positive real yield after inflation. So if you use the base inflation rate of 8.6, in order to revert to mean, the interest rate on the US 10-year Treasury would have to be 9%. Imagine the impact on federal, state, and local governments if the interest component, which is to say the interest payable on their accumulated debts, tripled. If you want to have even more fun, bring it home for your listeners, at least your American listeners. Traditionally, the US 30-year mortgage rate has sold at a premium to the US 10-year Treasury. So if free market yields prevailed, in other words, if we had a return to mean on the US 10-year Treasury and it was yielding 9%, that would suggest that the 30-year fixed first mortgage rate would be 9.5%. Imagine the impact on home affordability, on home sales, on home construction, if you more than doubled the 30-year rate. The point of all that goes to what is the Fed going to be able to do with the yield curve? They are signaling tightening, and they have done a wonderful job so far of letting the interest rate rise. But how far can they go? If they have a return to mean, what you will find is probably a brief, but a very ugly recession, similar to what we had in 1982 when Volcker let the interest rate on the US 10-year Treasury rise from 5.5 to 15.6. We know the way out of this, but it isn't pretty for a while. Will the voters, will the taxpayers, and as a consequence, will the politicians allow us to slay inflation by allowing the interest rate to rise? Experience tells me no.
So, do you think that oil prices could be a main problem that we should be solving to help tame inflation at all?
Well, I don't know. I don't know how a free market is a problem. The truth is that we put in place political measures as much as 10 years ago around the politician and the big thinkers' concerns around global warming to raise the cost of production, lower the capital availability to the oil industry. And then on top of that, of course, we had a huge demand destruction event around COVID. The consequence of that was twofold. One, the oil price fell from a pre-COVID level of 80 US dollars down briefly to below zero before stabilizing at $20 to $30 a barrel. At $30 a barrel, the industry on a global basis was losing about $30 a barrel in total cost on production of 80 million barrels a day, which is to say that the industry was losing in excess of $2 billion a day. And the consequence of that is that the industry deferred new project and sustaining capital investments of as much as $3 billion a day. And the consequence of that is that today we don't have the ability to produce as much oil as we burn. It's pretty simple. The cure for low prices, Cassandra, is always low prices. The cure for high prices is always high prices. Markets work, but they're really messy. If you believe, as I believe, that life over time almost always gets better, at some point in time, there will be some form of resolution of the conflict in Ukraine, and Russian oil will begin to return to market and not at a discount. At the same time, the very high prices that we're paying for oil over the 5-year time frame will do two things. They'll encourage conservation, because that's what people do over time when the price of something goes up, at the same time that you will begin to stimulate production. But that won't happen for a substantial period of time. We're trying to solve a political problem where there isn't a political answer. At the same time that President Biden wants the US oil industry to drill more, he's also telling them that their business will cease to exist in 2030. Why would you invest for the long term when the political class tells you that you don't have a long term? At the same time that he's vilifying the oil industry for not committing economic suicide and investing in stranded assets, he turns down the Keystone Pipeline, which could deliver as much as 1 million barrels of nice, safe, polite Canadian crude to US markets. To suggest that the political response to the problem is contradictory is, I think, to understand the circumstance. The best thing that Mr. Biden and Mr. Macron and the leaders of the G7 could do is nothing. Get out of the way, stay home, play chess, make pronouncements, let people buy and sell oil in the free market to suit their own utility. But of course, the big thinkers can never do that.
Okay, so Rick, what do you think the chances are that a recession will lead the Fed back to an easy monetary policy?
I think the chance of that, unfortunately, is very high. I think that the political class, the people at the Fed are very bright people. Sidebar, you probably know this, I'm starting a bank right now. That's how I celebrate retirement. And the consequence of that is that I've had to engage with the mid-level people at the Fed. And while I don't like the organization, I love the people there. They're smart people, but they're between a rock and a hard place. If they continue on the path of low interest rates, when we inevitably have a slowdown, they lose their most effective fiscal tool, which is to say lowering interest rates. They are to the point now where there is an increasing clamoring for them to do something about inflation. The difficulty with that is that we have a credit addicted world. And to the extent that credit becomes too expensive, the economic slowdown becomes politically unpalatable. As I was growing up as a consumer and an investor, we sort of anticipated a tightening. We sort of anticipated a recession, if you will, a reckoning, a cleansing every 10 years. And you organized your personal balance sheet around the fact that at some point in time, times would get tough. And the consequence of that is that you maintained enough liquidity that you could defend your existing investments, and you maintained enough liquidity too, so that you could take advantage of the illiquidity that other people might feel in a recession. People now seem to believe that they have a God-given, or perhaps in the modern age, a government-given right to have subsidized interest rates, and as a consequence of that, no recession, no depression. I would suggest to your listeners that they ask themselves whether they believe Mr. Biden and Mr. Trudeau and Mr. Macron and the rest of the big thinkers are competent enough that they can override the normal and natural forces of a market. My belief is that they can't. And my belief is that they will continue to allow interest rates to rise as long as they can. And when the consequence of increased interest rates begins to be felt in the economy, which is to say, when enough influential voters feel the pain, they'll lose their nerve and walk it back.
Okay, so you mentioned that you were starting a bank. Where are you starting this bank, and what made you decide to do that?
Many years ago, I backed a great group of entrepreneurs who started one of the United States' first online banks called Everbank. And it was a hugely successful experiment. They grew the bank from $0 to $28 billion in net asset value by servicing customers, really, and then sold the bank to a large institutional investor. That let me know two things. First of all, it let me know that there was lots of room in the market for a well-run bank. It seemed like every time I talked to large groups of subscribers and asked them if they're comfortable with their current bank, after widespread laughter, the answer is no. So it's an underserved market. I knew too that this team had done it before. But what I knew in particular is I introduced thousands of people to Everbank. And after the bank was sold, people started emailing me and saying, I'm an orphan. While this is a wonderful bank, it doesn't serve my needs particularly. So think of Everbank as a community bank, but where community was defined by an interest in certain types of investment products rather than by geographical locale. The new bank, Battle Bank, will offer the same type of innovative deposit products that Everbank did, which is to say foreign currency denominated certificates of deposit, as an example, market index certificates of deposit, certificate of deposits that are levered to the gold and silver price. And in terms of lending products, we hope to become the largest retail lender in the United States against physical gold and silver as a collateral, among other things. So think of us as a local bank, as a community bank, but where our community is defined as contrarian, natural resource, and precious metals oriented investors, and people who believe that a bank should, first of all, be conservatively operated, which is to say, have real equity, have real money, but also be focused on both deposit and lending products that service its constituency. It is absolutely true that we won't be able to compete with Bank of America and JP Morgan Chase or the Royal Bank of Canada. It is similarly true that they won't be able to compete with us. So that's why I'm doing it.
I love it. And I love the name, Battle Bank. Very cool. Okay, so Rick, I've got one more question for you here. Egypt, one of the world's major wheat buyers, is cutting wheat imports by 500,000 tons per year, or about 10%. The country's supply minister said that this is a move to combat soaring commodity prices. How concerned are you that we're looking at a global food shortage?
Markets work. What will happen is that the cost of food relative to the average global household budget will increase. Now, Cassandra, we need to put that in context. In my adult lifetime, which is to say in the last 45 years, the price of food in the United States, or rather the percentage of the average American household budget which is spent on food, has declined from 30% to 15%. So food has become, over 40 years, very cheap relative to other household expenditures, at the same time that the composition of the food budget has changed, which is to say 45 years ago, we bought groceries. Now people buy solutions. They buy meals ready to eat, all that type of thing. So we need to understand, particularly for Western people, that food is extremely cheap in the historical context. We need to understand, too, that 40 years ago, starvation, not hunger, but rather starvation, was a global problem. So we've done a wonderful job as humankind in increasing the availability of food to people. The downward march in food prices is probably over for a while. And I would suggest that in places like Egypt, there will be a shortage of affordable food, but there won't be a shortage of food. Note that, as an example, you have a global market in grain. So to the extent, as an example, that Egypt reduces its consumption of wheat, you'll find that Nigeria and India, as an example, might increase theirs. Food demand is fungible. If you reduce demand for wheat, what you do is increase demand for cotton, pardon me, for rice, for corn, for sorghum. A lot of these grand pronouncements from the big thinkers are all smoke, but no fire. But make no mistake, make no mistake, in the very first instance, food prices were going to go up anyway, because population growth has increased, because living standards around the world have increased, and because it's a globalized market. Now, with impending shortages, you're seeing food nationalization. You are seeing people confine food within their own borders when what they ought to be doing is maximizing production and maximizing trade. You maximize production by allowing prices to increase. The simple fact is, if wheat is selling, as an example, at $5 per bushel, and the price increases to $10 a bushel, two things happen. The people substitute some other form of grain for expensive wheat, at the same time as farmers find a way to produce more. The cure for low prices is always low prices, and the cure for high prices is always high prices. Markets are messy. Voters hate markets because voters believe that they deserve access to the products they want at prices that they want to pay. But that belief flies in the face of economic reality.
Okay, well, gave us a lot to think about today, Rick. Thank you so much for joining us. It's always so nice to hear your thoughts.
A pleasure. I'd like to leave one final thought with your audience. To the extent that you find these conversations interesting and you want to know more about natural resource investing, particularly your own natural resource investments, go to a website, ruralinvestmentmedia.com. List your natural resource stocks there. Please no pot stocks, please no crypto, please no tech stocks. I'll rank your portfolio, each company in it 1 to 10 if I know them. And I'll comment on individual issues where I think my comments might have value. If your listeners care about my bank, in the question section at the rankings database, just write bank, and we will send you information on the bank. Finally, I'm putting on the 28th installment of the Natural Resource Investment Symposium. July 26th through 29th in Boca Raton, Florida. If you have some interest in that conference, write conference and we'll send you some information. And thank you, Cassandra, for the interview.
Yeah, thank you, Rick. We'll talk to you later. Thanks so much for tuning in today. We'll be back again tomorrow, and you're not going to want to miss out. So be sure to hit that notification bell and subscribe below before you leave us. Bye.